Today's episode is sponsored by Free Trade, the commission-free investment platform that is revolutionising the world of investing in the UK market. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Stock markets have hit all-time highs in recent weeks, with Bitcoin and gold joining the party. When assets rally this strongly, inevitably people cry, it's a bubble. But just because you're paranoid, it doesn't mean they aren't out to get you.
I want to know how to invest if we're worried markets are built on sand. And in today's dumb question of the week, what's the difference between investing and speculation? All right, let's get into it. Whenever we have a bull market like this, Roman, it doesn't take long for the naysayers to show up, does it? Watch out for that bubble. This is why we can't have nice things.
But it's a danger, because if people use this as an excuse not to buy equity, I think that could ultimately be a problem. It could reduce their long-term return. So I think this is more of a dismissing of an excuse not to buy, rather than saying, oh my goodness, we're in a bubble and everyone should sell everything. I'd never say that.
I've seen a lot of people worrying that now is a bad time to enter the market. You see it on the PensionCraft forums, people just sort of wanting a bit of a pullback so they can get in the pool.
Yeah, I think that's healthy. And I think for most people, if they are just building up their investments over time, then you're going to be investing a lot in future anyway. It's for people who've already allocated everything, which I think creates the most nervousness, because there you haven't got another bite of the cherry. You haven't got any new capital to deploy.
But we've said before that the stock market is frequently at all-time highs as markets drift upwards. So why does it always cause us a bit of panic as investors? Like, we can never have an easy life, can we? It's either a market crash and we're in despair, or it's a big, strong rally and we're like, oh, it must be a bubble.
I think one thing is that people just think it can't continue. They think it's just too good to be true. You're looking at your portfolio and you're thinking, well, that's a pretty good rise. Surely this can't carry on. Or perhaps people are just risk averse and they're just more scared of the fall than they are of rallies.
Or perhaps some people have missed out on the rally. So there's a quote from Dominic Frisby, which is, a bubble is just a bull market in which you don't have a position. Which I quite like.
But even those who have got a position, and I know many of the people I speak to on the one-to-one coaching sessions, they have got a position and they are nervous. And they say, look, there's a big concentration in the US. Valuations look high in the US. Maybe I should just cut back some of my risk now.
I think it's also the speed of the rally, especially in some parts of the market. So, for example, Nvidia has gone up massively in, just a few months. And that scares people, doesn't it?
And another bellwether of euphoria, of course, is cryptocurrency, which we mentioned in the opening. And of course, that surged hugely. Great for me, because I finally got to sell my MicroStrategy shares at a gain, which was a bit of a shock. I just looked at the shares one day and I thought, oh my God, they're above where they started.
Don't you think it's weird that he just turned his company into a proxy for Bitcoin?
Well, I'm glad he did, because I can buy a Bitcoin proxy within an ISA wrapping in the UK. So that's the benefit. But I think what I'll probably do now is just wait until no one's interested in cryptocurrency again and then pile in. But by pile in, of course, I'm talking about my fund portfolio, so it's not much money.
But that's what people think about with stocks as well. They're like, I'll wait for a pullback before I get into the market. And maybe there won't be a significant pullback and you'll be locked out. And that could be true of Bitcoin as well. But maybe with the launch of these ETFs and all the flows there won't be a big crash this time. Who knows?
Yeah, maybe. Maybe there'll be money which is much more sticky and which leads to less outflows when it falls. But frankly, I doubt it. It is a speculative investment and I think it's probably going to tumble again.
But from a psychological bias point of view, don't you think you've just hit the nail on the head where you say, I'll wait for a pullback, I'll time the market?
Well, I think in the case of cryptocurrency, you haven't got the upward drift due to profits increasing. You've got the halving in supply, but you don't get any kind of increase in profits over time. So, whereas with equity, you've got that gradual drift upwards as profits increase. You don't get that for cryptocurrency. So I think, you haven't got that reassuring upward drift, and that worries me. Plus, you've got no idea of valuation. It's all euphoria. That's all it is. It's purely euphoria. And that eventually wanes as other things come along, as we saw previously.
So shall we try to tease out, in the market as we record this, how much is built on fundamentals, and here I'm talking about stocks, obviously, and how much is euphoria? So in recent weeks, lots of stock markets around the world have hit new all-time highs. The S&P 500, obviously. The Nikkei 225 in Japan, finally, after 30 plus years, has got back there. The Stoxx 600 in Europe has hit all-time highs. And interestingly, the equal weighted S&P 500 has also hit an all-time high, which kind of implies that the market has broadened out a bit. This rally isn't so concentrated as it was.
But I think always anchoring on prices is unhealthy. It's not really of any interest whatsoever. I think what's most important is price relative to profit. So price to earnings ratios are much more important because they are mean reverting, unlike prices. So I think focusing on things which drift upwards, well, of course, it's going to be at new all-time highs, as we said. It's just not particularly interesting. Makes for good headlines.
I was going to say, you're going to put headline writers out of a job here. But the other point is that these are nominal prices. They're not at all-time highs in real terms.
Yeah, and people seldom think of markets that way. I recently put out a video talking about the UK housing market where I was saying that it hasn't risen for 20 years in real terms. And I had lots of comments saying, you're just wrong. You know, I bought this house for this much 20 years ago and look how much it's worth now.
My anecdotes beat your data, Robin.
But I really had to double check the numbers. Laura said, are you sure?
I had that reaction as well. But then I remembered reading a piece, I don't know, in like 2019 or something from the FT where they looked at the housing market around the country and that it hadn't recovered from 2007 in a lot of places in real terms. And with the inflation we've just had, it doesn't really surprise me that we haven't had a real terms rally in house prices.
But 20 years, I mean, I was quite shocked myself when I saw that. And that's why I double checked the numbers, but it's true. So that's always a good way to think about assets. Think about the inflation adjusted value, but also compare it to the profits to see how much it's worth or how much you're paying for every pound of profit.
Well, let's look at that then for the stock markets. Let's go to our old faithful price to earnings ratio, forward price to earnings ratio, in fact.
So this looks at the forecast profits for the S&P 500 aggregated up from the single stocks that make up the S&P 500. So at the moment, the S&P 500 is at a forward price to earnings multiple of 20.4. Now that's not incredibly high, but it is pretty high. The median over decades in the past would be something around 16 times forward earnings, maybe a bit less.
So the data scientist in you says stock markets on a valuation basis are mean reverting, so we should expect to go back to 16 times forward price to earnings ratio at some point.
Yeah. But of course, the problem is that valuation's a very poor timing signal. So it doesn't tell you when it's going to pull back. And if you sell every time it's expensive, that's just not going to work. I back tested it, doesn't work.
And is that because profits could grow to make valuations look sane? It doesn't necessarily have to be stock price falls.
Yeah, it could be that profits grow to meet where the prices are now and prices don't rise as quickly, so they have a kind of slight slowdown as earnings catch up. Or it could be that euphoria just sticks around for a long period of time. This is what we've seen as a pattern recently in the US and also in India, where valuations are high and they've stayed high.
Is it true that in American markets, the price to earnings ratio has drifted up over time? I know we've had like massive dips, say after the financial crisis, where it really got down to single digits. But is it the case that valuations should be higher now than they were in the 50s?
Yeah, I mean, there is a case to be made. If you look at the time series, you can see that it has been high for a while, with a short hiatus during the COVID pandemic. Now, there were a few wobbles, but of course, it's hard to say what period of time you should average over. If it's a decade, yeah, they've gone substantially higher.
And would one possible reason for that be that it's just so much easier to buy stocks now than it was decades ago? You don't have to have paper stock certificates and store them in some vault. We can buy it in like 3 clicks on our phone. So that expands access to the market, and therefore we should expect valuations to be higher and possibly future returns to be lower. I've seen that case made.
That's one story I've heard as well, and I think it's a fair point. I think it's true that it is easier, and that would push up prices.
Not forever, though. Valuations would rise to accommodate that change and then possibly stay at a higher level on average.
Yeah, and I think it's useful to look at the trailing 5-year and 10-year averages. And of course, the S&P 500 at the moment is above both of those. So depending on how far back you look as normal, then it's still looking expensive. Not egregiously, but pretty expensive. So the 5-year average for the forward multiple is 19 times, and the 10-year average is 17.7, and currently we're at 20.6. So pretty high above those averages.
But it's not all about the US, is it? Tempting as it is when we talk about stocks. Do other markets look as expensive? So I can see that Japan, for example, is at a 15.3 times multiple, according to Yardeni, which is a lot higher than it was, but not as expensive as the US.
And as usual, Europe is in the doldrums. So Germany is at 12.1 times, UK is at 11.1, France 14.6. So that's pretty high relative to the rest of Europe anyway. Not compared with the US, but compared to Europe.
I mean, if we look at the world as a whole, the all-country world index is at a valuation of 17.7. But if we strip out the US, it falls to 13.7. So the US, it's a huge part of global markets, and it's doing a lot of heavy lifting when it comes to those elevated valuations.
And generally, emerging markets are looking cheap. So China is at 9.2 times. Korea, which is treated as EM by MSCI, strangely, is 11.3. Turkey, 4.7. The one which really stands out as expensive is India, which is at 21.7. So it's looking as expensive as America, in fact, a bit more expensive.
I think it would be hard to diagnose a global bubble in stocks, or even in the US from looking at these valuation numbers, though. They're potentially high, but they're not at a level where you look at it and go, Jesus, I'm going to sell my stocks because this is going to end in tears for sure. Valuations are certainly significantly below where they were in the immediate aftermath of the pandemic in 2020 and 2021.
But I think it's useful to look at other measures. For example, the CAPE ratio, which looks back at earnings over the previous decade, that's currently looking very high. So that's at 37 times historic earnings over the last decade.
And what would be a more normal level for that?
So the median since 1870 has been much lower, 16.4. So it's been cheaper 98% of the time since 1870.
You know what that suggests to me is that maybe we don't have a bubble in valuation. Maybe the bubble is in fundamentals, as in the forward PE ratio doesn't look so bad necessarily because the market's pricing in a lot of earnings growth. But looking backwards in the CAPE measure, that looked really expensive because we've had this rally in profits and in margins. Maybe that's the unsustainable bit.
I think that's a fair point. And I think the margins being this high in the US is unusual. So there's a question about whether there's any kind of social justice in having such high margins. But from the point of view of the shareholders, you could say that they've never had it so good.
Certainly if you focus on the stocks that are really driving the rally, let's say Nvidia, they've seen phenomenal sales growth. They've got incredible operating margins of over 50%. And the market's pricing in those margins to stick around and sales and profits to keep growing fast. I don't think it would take much disappointment to take the wind out of the sails of a stock like that.
No, I agree. And if you look at Tesla, for example, you've seen its share price fall, I think it's about 30% year to date. It's still at a 50 times forward earnings multiple. So I think there's a lot of euphoria still in some of these stocks because people have some weird expectations about what it's going to do. With Tesla, it's a story about becoming a software company, about hiring out your Tesla as it autonomously drives to service clients across your neighborhood. So I think all of that is potentially going to happen, but it shouldn't really be priced in with such certainty as we've got now. So I think you're right. If the AI narrative starts to crumble and people just assume it's going to be built into products and we start to get a bit bored of the stories about fancy images being generated or tunes, then I think ultimately the valuations will come down again.
There was a really interesting graph in Bloomberg which looked at the ratio of the S&P 500 momentum index. So this is focused on stocks where their price gains have been really strong recently, and comparing those stocks to the broad S&P 500. And the momentum index is at its highest relative level since the dot-com bubble.
Now, this isn't mean reverting this one. So there's no reason why the ratio of this momentum index relative to the S&P should ever mean revert. But the fact that it's going up tells me that people are buying into a trend which is consistent, which in this case is growth. growth stocks, mega cap growth stocks. People are just piling into that at every opportunity. You know, there are risk-off periods, but they're quite brief, and then people just go back to what worked in the post-pandemic rally. And I think that's worked very well. And it'll continue to work while the narrative persists and while people carry on doing that. So ultimately, this is driven by behavior, human behavior and psychology. Today's episode is sponsored by Freetrade, the commission-free investment platform that is revolutionizing the world of investing in the UK market. Freetrade offers you over 6,100 US, UK, and European stocks, ETFs, and investment trusts. With over 1.5 million users on board and having won the best online trading platform at the British Bank Awards 5 years in a row, they're a well-trusted trading platform. With Freetrade, investors have the opportunity to manage their investments in a tax-efficient way by opening a stocks and shares ISA. For those looking to consolidate their retirement savings, Freetrade offers a self-invested personal pension, or SIPP, so you can bring all your old pensions under one roof. And speaking of ISA and SIPP, Freetrade has a limited time offer giving away a free share worth between £100 and £2,100 when you open and top up or transfer an ISA or SIPP with at least £10,000 before 5th of April 2024. Curious how it works? Here's what you need to do. Download the Freetrade app, open either an ISA or SIPP account with an annual standard or plus subscription on or before 5th of April 2024. Top up your account or start a transfer for at least £10,000. Keep your account open with a balance of £10,000 or more, and we'll drop the free share into your account within 90 days of campaign completion. Head over to freetrade.io/transfer to learn more and get started. Remember, this offer closes on the 5th of April 2024. Capital at risk, ISA and SIPP eligibility, tax rules and terms and conditions apply. Free share value varies depending on the amount topped up or transferred. Annual subscription required. Other charges may apply.
I guess the question at the heart of all of this is, are we looking at a kind of rational optimism here? Or is it irrational exuberance? Or what's the ratio between those two things? There's always a bit of both, isn't there?
Well, I think the fact that the earnings multiples haven't surged upwards and that profits have suggests that a large proportion of this rally is due to fundamentals. And I guess you put it nicely, which is to say that there's a bubble in profits at the moment, and that might not be sustainable. But ultimately, that'll turn over to a long-term trend, probably, because profits do that. They do grow at a certain trend rate, something like 6% real since the Second World War for the US, as far as I remember. And then stocks, of course, keep pace with that.
I feel that we can't do an episode on potential bubbles without mentioning Jeremy Grantham. Did you read his recent note? Were you surprised he was calling it a bubble?
Not really, no. I mean, look, the guy's great. I love what he says, and I love the way he just presents it in a very rational way, and he makes it fact-based, but maybe he's being a bit selective with the facts.
So the facts he mentions are that a CAPE ratio of 34, as of the 1st of March, is in the top 1% of history. Here he's referring to the S&P 500. And he says, and I quote, "There has never been a sustained rally starting from a 34 CAPE ratio. The only bull markets that continued up from levels like this were the last 18 months in Japan until 1989 and the US tech bubble of 1998 and 1999. And we know how those ended."
This reminds me of La Peste, you know, the novel. There's a guy who calls out the plague and nobody wants to hear it. He's a bit like that. He's the Cassandra. And people don't like to hear it because if you see your portfolio doing well, you're not going to like the guy who's saying that, you know, it's all going to end and you're going to have valuations coming down.
I think the thing with Grantham is people don't like to hear it every year from him. But he's going to be right one time.
But I remember previously his case was that what you should buy is low valuation stocks in EM. I don't know how well that's performed, but that was his idea, that the US was overvalued and that you should look for value elsewhere, preferably in emerging markets.
I mean, what do you think about his point, though, that using this backward-looking CAPE measure, as we've said, markets look very expensive, and that from that level of valuation, there's never been a rally higher? or at least only on 2 occasions, and it ended in disaster.
But the thing, if you're going to compare it with 2000, is that that bubble was driven by pretty much vapor. It was all about narrative, and there was very little profit growth, if any, and many of the companies were loss-making. Whereas in this revolution, if you want to call it that, the companies behind it are very profitable. Nvidia, very profitable. And a lot of the other AI-type companies which have used AI or are developing it are also very profitable. So that's why I think this one is sustainable. And I think in order to pop this bubble, there's just going to have to be widespread disappointment in the profit growth, because that's what really people are expecting now.
Interestingly, Grantham does believe the hype on AI, at least in terms of its technological and social impact and its impact on markets long term. He just thinks that's already priced in and more to current stock prices.
And he says if margins and multiples are both at record levels at the same time, it really is double counting and double jeopardy.
It does amplify the risk, doesn't it? Because either margins could fall or multiples could fall. Either will get you into a crash scenario.
And if margins fall, I bet multiples would too. So I see what he's saying. And if things do turn around, then it could be very unpleasant and it could be very sharp, the sell-off.
While we're being devil's advocate and making the bear case, I saw an interesting quote from Ian Harnett of Absolute Strategy Research, where he said, US tech earnings already account for 23% of US earnings as a whole. In the past 50 years, only energy in 1980, healthcare in 1992, and consumer discretionary stocks in 1978 and 2017 have briefly managed to sustain 20% plus shares of US earnings. Once a sector reaches this scale, the issue is where and how can you generate incremental earnings growth? So I guess what he's saying is tech's already so big, and that's where people expect more growth to come from.
I guess the question is always who's paying for the tech? Is it consumers or is it other companies? And at a certain point, the other companies are paying for those tech solutions with their own profits. So there is a case to be made that they won't carry on paying for those things forever and paying an incremental amount of their profits into the one sector that's cannibalizing the rest.
You know what I thought when I read this quote? Is that the sector classification feels so out of date to me. Like technology, for one, doesn't capture all the technology companies. Amazon is not a technology company, according to the sector breakdown. Google isn't either. So maybe the tech sector is even bigger than this makes it look. Or maybe it's the case that every company is a technology company to some degree, or it's going that way.
You can't be a company without having some technology, as I know, because we have to pay for our website and all of the gubbins that goes with it.
But do you know what I mean? Like diagnosing market concentration based on sectors seems a little strange to me these days.
Yeah, it's kind of like electronics companies in the 1940s. All companies use electronics, all the devices that are in our house. And then ultimately the classifications change to reflect that. So I think you're right. Tech changes over time. The classifications change over time.
It seems to me that the story's changed over the last year. Like stocks started rallying and everyone said, this is because markets are anticipating rate cuts. And at one point, the market was pricing in 6 or 7 25 basis point cuts from the Fed this year. And that's now fallen to an expectation of 2 or 3 cuts. And yet stocks have kept rallying.
Which is good, because I think markets have come round to what the Fed guidance has told them is likely to happen, which is inflation's sticky and they're not going to be aggressively cutting rates while that remains the case. So there won't be a shock down the line. That's the good news about that capitulation.
I guess the bad news about interest rates potentially staying higher than previously expected is that it could depress growth and therefore earnings.
Yeah, and that's just not being priced in at all. So I think that's a worry. And this could just be fatigue. Markets are just getting bored of this relationship and saying that every time there's going to be an increase in interest rates, it's going to make growth tank. And if rates fall, then it's going to make growth surge. Whereas it seems as if these profits are like a juggernaut that you just can't divert. Ultimately, I think what will derail this will be when those profits stop growing so quickly. I don't think it'll be so much about interest rates.
I mean, we've talked a lot about the bear case and the fact that there could be euphoria. But on the other hand, what's the evidence that there isn't so much euphoria and markets are just fairly pricing in expectations?
Well, if we compare the price to earnings multiples with previous peaks, this isn't as peaky as the dot-com bubble, for example. And many of the Magnificent Seven are trading pretty much close to their average price to earnings multiples over the last decade or so.
Yeah, they're trading at around an average of 30 as a PE ratio, whereas in 2020, they got up to almost 45 times earnings. And the other thing is the Magnificent Seven stocks, as we've mentioned before, have kind of diverged from each other. You mentioned Tesla's been falling significantly, down more than 30%, I think, this year, whereas Nvidia's been rallying massively, and the others are sort of spread out in a fan between there. To me, that's encouraging because it says the market's actually doing its job and looking at the relative performance of these companies. It's not the case that, oh, they're in the Magnificent Seven, buy all of them.
Yeah, and if you just go back a couple of years, you can see that Tesla, on most of these forward price to earnings graphs, simply goes off the top of the graph. It goes beyond 140 times. So we are coming out of a frothy period to something which is more fundamentally driven, which I think is healthy. And when a company does disappoint, like Apple, for example, with its profits in China looking like they're under pressure, then we do see the share price being punished rather than completely ignoring the bad news, which is also healthy, I think.
Yeah, that's the difference, I think, between now and that crazy rally after the pandemic, is that then there was a lot of rallying in non-profitable tech companies. And that's what drove ARK-K's performance higher, right? It was all these companies which were promising returns in 5, 10, 15 years. Whereas now, companies are having to deliver strong earnings or the market's not buying it.
And as one of the signs that nature's healing, if you look at Goldman Sachs' non-profitable tech index, which was the one that rallied hugely during that pandemania rally, that's been falling fairly steadily since the beginning of 2024.
Meanwhile, the Nasdaq's been rallying. So this is what we mentioned. There's a divergence between good tech, if you like, and speculative tech, as there has to be when interest rates are above 5%. You have to deliver actual money to shareholders.
Another bellwether for euphoria is the number of IPOs. These are initial public offerings as new companies get listed on the exchange. And that surged in 2021 at over 1,000 IPOs. And this is for the US stock market. And then it crashed in 2022 to 181 and then fell further to 154. And so far in 2024, we've only had 33 IPOs. So this is not a good market to launch a new company.
Yeah, because inevitably companies want to go public when there's a lot of money sloshing around. Investors are willing to throw it at new companies, which was obviously the case in 2021 and is less the case now. Although there are signs that it might pick up. So, for example, Reddit is planning to go public. And I think there's the big one of Stripe always in the background. Is that going to go public?
But if you hear about the VC market as well, that's also dried up. So if you're a tech company looking to expand, and a couple of my clients are VC CEOs or in the C-suite of a tech company, they tell me that it's very, very difficult to get additional capital now compared to the way it used to be, where people just threw money at you.
I mean, it's a hard one to call, whether this is really fundamentally driven or euphoria driven. There's evidence on both sides, as there always is, hence why it's very hard to diagnose a bubble in real time. But what do you think? What if you come down on the camp of, yes, this is a bubble, potentially? How should that affect your behavior as an investor?
Well, you know what I'm going to say. It shouldn't affect it at all. For me, I'm just going to carry on investing in equity as much as I can for as long as I can and pretty much ignore everything that I hear about valuation or anything else.
You're not going to listen to this podcast back then?
But I think for most people, that's probably the best thing to do. The point about valuation is that it doesn't tell you when to sell and it doesn't tell you if to sell because things stay expensive. And that's been the case for a long time now.
Yeah, that's definitely true. But I think now might be a good time to check that you're happy with your portfolio. Because you never want to sell in a crash. We're definitely not in a crash, right? We're at all-time highs. So maybe it's a good time to check that the level of risk you have in your portfolio is what you actually want. It might be a good time to rebalance if some of your holdings have done really well and some haven't.
So Laura, for example, has cut back on her Nvidia holdings. So she had a 100% increase. So she decided to take some profit and move it into other investments. And I think that's sensible. And I think the way to do this might be to say, well, let's imagine that we get a 30% pullback. How would I feel about it? and just visualize what your portfolio would look like if that happened. How much cash would you have left, and how would that make you feel? And if you're not comfortable with it, then maybe consider de-risking slightly, or just kind of move the allocation away from the stuff that's done well, as Michael says.
Certainly if you think we are in a bubble and you're just doing the good behavior that we've said and just sticking with it, not making any changes, I think, as you say, if markets do crash, you will kick yourself and say, I knew it was a bubble. So you've got to try and minimize your regret, probably psychologically, to stop yourself doing the bad behavior if we get a crash.
And that's why rebalancing is a good discipline, because if you do get huge winners, then it makes sense to reallocate at a certain point. Maybe not too often, once a year is probably enough. But then you won't be nursing such large losses potentially if there is a pullback.
And the other situation some people find themselves in is that they get a big lump sum from selling a business or inheritance or a lottery win, whatever it might be. And you get the inevitable question, should I stick it all straight into markets, or should I drip feed it, dollar cost average it over time? And especially when markets look expensive, people get nervous, don't they?
And that's what I've been hearing a lot recently. And I can see why people say it. And often they end up concluding that they will drip feed. It's just a question of how long the drip feed's going to be and whether they're actually going to accelerate it if markets do fall. That's the thing you should promise yourself.
But shouldn't you just stick it all in if we're saying valuations aren't a timing? We've talked before about how Vanguard did a study and lump sum, as in just putting it all into stocks straight away, beats the dollar cost averaging 66% of the time.
Yep, and that was true of all three markets they looked at, Australia, the US and the UK, which is interesting that it's true across all of the markets. So rationally, yes, most of the time you're better off just putting it straight in. But as we know, a big part of investing is psychology and really what you're comfortable with and a portfolio you can live with. So I think there it's important to consider how you'd feel, I think, if markets did fall.
Nah, just chuck it all in. Be rational. Don't you think it's weird, though, that you're like the maths nerd and being like, oh, it's all touchy-feely? Do you know what I mean?
Yeah, but it's also based on other data, which is that usually you're better off just putting money in. And this is based on a back test I did myself, which just showed that if you hold money back when valuations are high, it just doesn't work most of the time.
Whatever it takes to get you to buy some stocks is good, right? If you need to drip feed it in over a year or two to stop you just sitting in cash, then yeah, maybe the way to go.
We quoted a couple of these valuation measures during the course of the podcast, and as a member of PensionCraft, if you go for our premium website membership, you'll get access to those trackers. So if you want to join our membership, just go to pensioncraft.com to learn more.
Okay, today's dumb question of the week is, what is the difference between investing and speculation?
For me, I think the difference is excitement. If you're getting excited when you trade, then it's probably a sign that it's speculation. It should be kind of like doing the washing up or switching on the dishwasher when you buy stocks. It shouldn't be something which is exciting. Because gambling, it's all about that exciting feedback, the thrill of losing money or making lots of money, and the low probability high payoff. That's what really marks out gambling, I think.
Yeah, interesting. I think there is a subtle difference between speculation and gambling, which is that speculation, you are going into it with the expectation of a positive return, even if it's a low probability, high payoff event. Whereas gambling, you're going in knowing that the house always wins when you're playing roulette. If you play roulette forever, you'll lose all your money. Whereas, market speculators who are good at their job in the futures market might be profitable, even though they're playing a low probability game.
But isn't that the psychological difference between gamblers and non-gamblers? A non-gambler will always think, yeah, the house always wins. The gambler thinks, for most people, the house always wins. But for me, it's different.
Yeah, I guess that is a psychological difference. For me, the difference between investing and speculation is a few things. It's like the holding period. For me, an investment should be something ideally you could hold forever. Like you could buy a broad stock market index and literally hold that forever. Whereas speculation is going in expecting a short-term rise and then you can sell it.
Yeah, the short-term, long-term one is another good hallmark, I think, also of speculation.
The other thing I was thinking is that investing is perhaps more when you buy something which inherently generates cash flows, whether it's a stock that's selling things to customers and is able to pay dividends, even if they're delayed until the future, or a bond where a government is borrowing money and investing in the economy, taking in money in taxes, and then is able to pay you interest on the bond. So it's generating money. Whereas speculation is maybe in things that are more like gold or Bitcoin, where to a large extent you're reliant on maybe a greater fool down the road buying it from you at a higher price to make money. It's not going to make money on its own.
Yeah, I feel that difference. It's a zero-sum game for a speculative investment like a cryptocurrency. Whereas for something like buying a stock of a company that makes products people like and love, you're kind of engaging with that company and helping it. This is the kind of feel-good part of capitalism, I think.
Yeah, you're giving capital and it's going to do something, right? With a stock or a bond. It's actually going to make a product or build a bridge or something. Whereas if you buy some gold, the gold's going to sit there, right? The capital's gone to the person who owned the gold before. But I guess there are some markets that we need, commodities markets, futures markets, where you need speculators, maybe. They help find the price of what the underlying commodity should be.
Yeah, for example, in the futures market, you have to say what kind of trader you are when you enter that market. Are you a hedger? In other words, someone who actually trades in the underlying commodity and is just laying off their risk.
So would that be someone like, I'm a farmer growing crops and I am buying a futures contract to hedge the movement in the price of grain?
Yeah, just ensuring that you're going to get a good price at some point in the future. So you lock in the price and that takes away all uncertainty. You might still lose out if the market's actually surging in price. You're going to not participate in that, but you don't have to hedge the whole crop. You can just hedge some of it.
Or I'm an airline hedging my oil exposure.
Yep. Or a jeweler, which buys gold. You don't want the price to surge and increase your input costs. And then you have speculators, which are usually companies which are investment companies, hedge funds, for example, where they're just speculating on the price movement one way or another.
And are they often taking the other side of the trade from the hedgers?
Yeah, because the hedgers will almost always be long the market. They'll buy a long futures contract, and somebody's got to take the other position, otherwise the market won't work. In the futures market, for every long, there has to be a short. So that's why the structure of the market completely depends on speculators to take the other side.
I don't like the idea of being a hedger or a speculator. Is there something else I can be?
An arbitrageur sounds cool.
Yeah, that's much better.
But there you're looking at the difference between the two markets and hoping the prices converge.
So arbitrageurs are trying to make money risk-free, is the theory. I'm sure if I tried this, I'd find a way to lose money. So in defense of speculators, we've said that in some markets, at least, you need them because they're taking the other side of the trade and providing liquidity and helping find the price, which is all a good thing.
And in fact, one of my favourite stories is about one of the first futures trades, if you like, which is the story of Thales. And this is related by Aristotle, the philosopher. And it was in answer to the question of, okay, you're so clever, why aren't you rich? So people often slagged off philosophers at the time because, what was the point of being a philosopher if it didn't make you wealthy?
I mean, we're still saying that now, 2,000 years later.
But he tells this great story. He says, according to the story, he knew by his skill in the stars, this is Thales, while it was yet winter, that there would be a great harvest of olives in the coming year. So having a little money, he gave deposits for the use of all olive presses in Chios and Miletus, which he hired at a low price because no one bid against him. So he was cornering the market at this point. When the harvest time came, and many were wanted all at once, and of a sudden, he let them out at any rate which he pleased, and made a quantity of money. Thus he showed the world that philosophers can easily be rich if they like, but that their ambition is of another sort.
Basically, red sky at night, farmer's delight, is what he's saying.
And then he slags off monopolies. Yeah, I mean, it's a great story.
Why do speculators get such a bad rap then, if we need them? Like, often when there's a real volatile market, people start blaming speculators, right? You see it all the time.
Yeah, if it's something like a food market in particular, there you could say that the speculators are bidding up the price, except for the fact that they usually go short. That's the flaw in the argument. But certainly if there were lots of speculators, hedge funds buying futures or going long, then yeah, you could argue that that was going to push up the price and make food more expensive. That would be inflationary. And of course, food is a political issue because for poor people, food makes up a large proportion of their consumption basket. So literally, you're taking food out of people's mouths if you push up prices.
I guess there's a fine line between speculation and market manipulation. Are you aware of the 1958 Onion Futures Act in the United States?
Yeah, I had heard about it. Yeah, it's great.
Yeah. It banned the trading of futures contracts on onions because two onion traders, Sam Siegel and Vincent Kosuga, cornered the onion futures market on the Chicago Mercantile Exchange. And I believe the same act also banned futures contracts on motion picture box office receipts. So you can't speculate on those either.
It's such a specific set of markets. I love it.
Ultimately, markets are like an onion. Doesn't mean anything, but we'll end it there. Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.